takes a vacation and like his brain checks out and, wipes his memory clean.
What are we here doing again? What are we doing again? What's my name?
Hey there, and welcome to episode 46 of Rein It In. Last episode, we looked at a number of headlines and what goes on behind the headlines, digging always for what is real. This episode, JG and I look and dig deeper into inflation, new construction, mortgage growth, or should I say the lack of, as well as GDP. And man, we just can't go anywhere without looking at the recent CPI. Let's talk about it. Listen in. And remember, folks, just a polite nudge. Remember to subscribe, hit the bell notification, throw in some comments, definitely let us know.
You're reading the newspaper, you're listening to the news, if you're on social media, which, by the way, I find fascinating that some people don't listen to the news anymore, but they get all their news from social media, which is like, no, not any more trustworthy for news. I find that funny. But inflation is the big topic of conversation, Patrick, because right now inflation is coming down at a rapid rate. And I just saw a headline earlier this morning.
Inflation lower than it's been in 40 months.
They wrote on the recent headline I saw this morning. So, I mean, everyone is screaming this from the mountaintops. What do we got to say about it, Patrick?
Well, I think there's a fundamental that we have to always remind people is that inflation, and when you look at the CPI number, people get confused. I hear it all the time. I see it in different posts. And the reality of it is that prices are not coming down. So CPI is literally the speed of which things are inflating. So as much as the government of Canada or the Bank of Canada says we need to hit 2%, just remember that's the speed. It's like, okay, we're doing 100 kilometers an hour. We're going through a small town. Let's bring it down to 60 kilometers an hour. So that's the real story behind inflation that I think that people overstep because they get confused. They're going, yeah, well,
inflation's, what are you talking about? CPI is down. Prices are still ridiculously high.
Because they are.
I'll have the Thai chicken pizza. But hey, look, if I get it without the nuts and leeks and stuff, is it cheaper?
Most prices remain high, especially in those things that we need, like food and fuel and shelter. And all that's happening is the speed of which prices are escalating is in fact slowing down. I just want to make that really clear because it is a conversation that confuses people. So prices are not coming down. Some services are, some minor prices are coming down, but not in general. The good news is the CPI is slowing. So in other words, demand is slowing, which is all that the Bank of Canada can really do. I think that's another point. What are interest rates? They're not controlling inflation. They're controlling demand. So as prices go up, demand comes down. And so ultimately inflation slows because people aren't spending money. So I guess that's a long answer to your, question about inflation, but ultimately what it's going to mean, I think, given this most recent inflation CPI number, is we're going to see another decline in interest rates in September. There you go.
Oh, was that a Patrick prediction right there? Is that a Patrick prediction?
That's a Patrick prediction. I feel pretty safe in that. I'm just following consensus, but I agree with consensus. I don't always agree, and I'm often wrong, so that's okay.
I'm gonna go again with my prediction, which, as everyone knows now, I don't make predictions on what I actually think is going to happen. I make predictions on what I hope is going to happen, like what would be best for real estate investors. I would like them to drop 50 basis points, so a double rate cut on the next one. That would really spur things up and make things very, very interesting, Patrick. Albeit we should talk about bond yields as well, too. That's not on our topic, but maybe we'll throw it in there, Patrick, because bond yields have been very interesting. But before we get to bond yields and interest rates, I want to talk about inflation real quick because I have a couple of thoughts on this, which is we're now at this, from my perspective, being a business owner, you're a business owner, Patrick, and I don't know if you're seeing any of this, but I will say it this way. Number one, I expect very soon, and I don't know if that's in the next 4 months, 6 months, 8 months, but in the next number of months to a year, you're going to start seeing headlines about deflation, I think. That's what I think is going to be the next big concern. I'm curious to see if that's going to happen. But before we go into the deflation conversation, and here's partially why I think that. Just earlier today, I was having a conversation with my wife, and we were talking about a competing business. My wife and I own a business together. We were talking about a competing business who recently closed their doors after 25 years of being in business, shut their doors. So I said to my wife, why did they shut their doors, right? So she says, well, they just couldn't keep up, blah, blah, blah. There's a bunch of reasons for it. I said, well, that's very, very interesting. Now, there's another competitor of ours, which is very close to shutting their doors. They essentially have the productivity of call it a productivity factor of 10. They're operating at 1.5 of their overall productivity. They can't even pay their rent right now, I'm sure of it. So they're going to close their doors very quick. So I had said to my wife, well, what about that business? What's going on with them? And this is interesting, and I've been seeing this more and more. She says they've priced themselves out of the market. So because of all the inflation and people have been raising prices to try to keep up with labor and try to keep up with other costs, I get it. But sooner or later, people are going to say, enough, I'm not doing this anymore. That business has now priced themselves completely out of the market where they might have to shut their doors because they're not getting the business. You know who else is struggling with this? Starbucks. Did you hear the All In Podcast boys and their conversation on Starbucks? Fascinating. But I think that there's a couple of comments in there that I think the people are absolutely correct, which is, I know I've boycotted Starbucks only because I'm not paying $8 for a cup of coffee and I can afford it. And I have no problems affording it, but I'm just not going to pay $8 for a cup of coffee and wait 20 minutes in a drive-through. Just not happening. I decided no. So I haven't bought Starbucks in I used to go to Starbucks almost every day. I bought Starbucks for a year. So I think and Patrick, the only way to respond as a business owner, as you very well know, because you are one, been a business owner for 42, 43 years, the way these businesses are going to respond, they're going to cut their prices. They have no choice.
Well, hear what you're saying, and I don't necessarily disagree, but I think there's a fundamental. When I hear about small businesses going out of business and insolvencies, especially businesses that have a track record of what you talked about of 20 plus years, it really kind of breaks my heart because you know what it takes to operate as a small business. And some might say, yeah, well, they didn't operate it well or whatever the story might be, but you don't know the circumstances in behind the scenes. So I have a lot of compassion and empathy for small business owners. It does not, and I've had competition over the years in different businesses where they've gone out of business. It actually doesn't make me happy. I don't go, yeah, well, he was a this or that. It does not make me happy. It actually saddens me to see this is what's happening. I think the fundamental that you're seeing with Starbucks, for example, we'll use that as an example, or the businesses, your competitors for you and Carrie, is that there is a fundamental challenge that we face, is that how can we manage costs? So we don't know their rental circumstances. We don't know their operating cost circumstances. A lot of decisions were made when things were better, and then that may come back to haunt if you didn't have the foresight or you didn't plan that way. My point is this, is that I don't think you're going to see prices come down, because the reality of pricing with businesses that are honest in what they're doing, all they're trying to do is pass their escalating costs on to the consumer, which makes sense given the cost of delivering those goods and services has been increasing, which is all to say this. Ultimately, what's going to happen is you're going to continue to see insolvencies. You can't run from a negative cash flow, negative balance sheet. I've been there, done that, and it is really, really challenging. So I think you're going to see more insolvencies. And of course, if we get it into real estate, guess what's happening? We're seeing it in developers and builders, and it's really a challenge in Vancouver and Toronto right now in the condo market. So all to say this, rising costs, they can't pass those costs on. On top of that, they got rising costs that literally they can't control with our government and our municipalities, and the results are there. So I'm a little bit concerned about what's going on in that regard.
Yeah, it's interesting, Patrick. And I think that, there's no doubt, I think you're right, that you're definitely going to see some insolvencies go up for sure. Definitely bringing down debt payments is going to be a big help, because a lot of these things are governed by debt payments. Like Patrick, you were talking about your example of your industrial location of real estate. You happen to be the landlord and the tenant, but if you were just the landlord, not the tenant, you would have doubled your rent. You would have doubled the rent to the tenant because you had to, because your payments doubled.
Yes.
So as a result, you would have had no choice. Now, as your pricing comes down, you would have a few levers that you can hit. You can bring those payments down. That would help the business, so on and so forth. So I do think, I agree, insolvencies will go up, but I think that the businesses will be as scrappy as they can be, and they're going to try as much as they can before they go out of business. They're not just going to say, oh, that's it, I'm out of business. They're going to try everything they can, and bringing prices down will be one of those things they try. And I'm curious to see what that's going to happen, because I think we're at that point of the life cycle where you're going to start seeing more and more people do this. You're starting to see, you're starting to see, like, I'm hearing it all over the radio stations now. I mean, the advertising that's going on, everyone is now again fighting for business, where, hey, most people lost that edge. Most people forgot how to fight for business, because the good years of 20, COVID 2020, mid 2020 to 2020, early 2023 were so good for so many businesses. They forgot how to market, how to advertise, how to fight for business. That's all coming back online. And I think price drops are for some is going to be what's next. So curious, very, very curious.
Okay, but we need to spend a little bit more time on this, because the people that are not, those individuals who are not small business owners or have a job, and by the way, and or work for a government, which I don't need to go there in many regards. But having said all of that, my point is this: is that some will say, well, it's survival of the fittest. This is a way to cull the herd, and the strong, only the strong survive. Got all of that. And while that is certainly got a degree of truth to it, what we can't step over as these insolvencies increase, which I believe they will over the next year and a half, we're going to start to hear more about it, because we're just now, the lag is coming through. We've talked about lag many times. The point is this: that translates to unemployment. So as businesses go insolvent, and it's not all just small business, by the way, JG, back to your Starbucks comparison, they're literally shutting down locations, which means how many people within those locations are there? Is there 10, 15, 20 staff that, rotate through the baristas and all the rest of it, and maintenance and all the things that go with a Starbucks location, as an example, means that those jobs are being shut down. And that is, of course, something that is going to then slow down the economy even more. These are challenging times, and the lag is starting to really hit now. And it's hard to be optimistic when you consider what's going on in the world.
One more thing with inflation, Patrick, that nobody ever talks about. I don't even know if you realize this is part of the inflation calculation, but as part of inflation, like, let me give you a perfect example. So Patrick, you're a proud operator of an iPhone, as I am.
That's so proud.
Do you just like a proud papa. But did you realize that in the world of iPhones, and not just iPhones, but in the world of like smartphones, mobile phones, smartphones, in that world, they are hugely deflationary, even though we pay more for an iPhone today than we've ever paid before. But because they actually calculate, as part of inflation calculation, they calculate the ability of the device as well, meaning the device can do so much more than it could 5 years ago. As a result, even though it only costs $200, they put a value on the fact that that thing can do 10 times more than it used to. Therefore, it's overall deflationary, which is interesting.
Well, I'm very aware of all of that, and the way that they calculate CPI. It's a manipulated number, and that's why we sense so much frustration economically, because it says one thing, but when you unpack it and you look behind the curtain, which we're going to talk about housing starts at some point along this conversation, you realize when you get behind the scenes and the numbers are, you cannot take them for face value, JG. They're just often not true. They're overstated, understated, and then you unpack it and you see what's going on. So in this particular slide that we've got going on, you look at housing starts, the highest in 13 months. Oh my gosh, that is amazing, because now the government, Freeland and Trudeau can stand up and go, look at what we've done. We told you we're on track, but it's all bull. This is stuff that is coming to fruition from 4 and 8 years ago. There's actually an article Bloomberg wrote about it and shone a light on it, which I thought was awesome. It's about time somebody calls it for what it really is. Sadly, not enough people will really realize that. And it's important for investors. I mean, that's who we're talking to here, is real estate investors, maybe some first-time home buyers within the self-funding house ecosystem. The point is this, is that when we look at real estate, everybody's thinking, oh, they've got all these stuff coming online and the housing starts are up. They're not up. They're actually down. Like, stuff today is not going online. Developers are not developing. Builders are not building. And this statement is, when you look behind the curtain, you realize that 4 to 8, as long as 8 years ago, this stuff is coming online. And why does it take 4 to 8 years? because of government bureaucracy. Thank you very much. Anyways, the point is that this is such a bull headline. It pisses me off.
In the show notes, Patrick, we should include that CBC video you and I watched this morning, because I think that's very interesting, and I actually like the job that the gentleman did, where he talks about the cost, the escalating cost, specifically on the taxes. The taxes are unbelievable on these developments. Now, listen, I can say this till I'm blue in the face because I am a developer, and I hate these taxes. But when people see it from a different perspective, it just rings differently. And I thought the guy presented it really, really well. This stuff adds up in a huge way. I mean, hey, when you think about every 2-bedroom apartment has somewhere between $45,000 and $60,000 of development charges and taxes built into it. Just think about that. You wonder why rents are so high. Don't have to wonder very long, guys. It's because of all these extra costs that are built into this. It's unbelievable.
Well, let's keep ranting about this because it's really, I think it helps people understand. It's not going to change a lot of things, but here's the fundamental around it. So consider why it takes 4 years. And there's a lot of reasons it takes 4-6 years to get a project going. So they pencil the deal early on. Then they go through all of the hoops that they've got to get with zoning. Well, that takes a couple of years or more. And let's just consider what happens over that 2 or 3 year period that they're fighting to get zoning and going through all the hoops that the bureaucracy asks them to go through. Are costs going up or are they going down? Well, we know they're going up. So where they started 2 years or 3 years earlier in getting it done, they have to anticipate costs. Then they actually launch, and then it's going to take that time to build it. And while they're building, costs again are escalating, not the least of which changes in tax structure, for example. So this is Canada's really, I think, broken when it comes to that sector and some of the things that we have to do. I mean, it's a lot of conversation going on these days around it. But the point of it all is that it's very, very difficult given the escalating costs over that period of time, the hoops that we have to jump through. The government continues to talk about,
well, we're on it. We're going to build 4 million homes.
The biggest lie right now that they can state. I mean, they state many. But the point is that when we look at this, there is no way for these developers to control costs given the timeframes that are on. And ultimately, it's got to be passed on. So as much as we think that the cost in housing is about the lack of supply, that there is a degree of truth to that, but it's also what they have to do to get a product to market and the length of time it takes and the rising costs between the start and the completion. And that gets passed on.
You're right. It is a lack of supply, but that no one's asking the next question: why is there a lack of supply? And go pulling on that thread, and as do some first principles thinking around that, and you'll quickly get to the answer. So it's very, very fascinating, Patrick, and it's interesting. They publish these headlines in the wake of all that stuff. I find that to be. If I didn't find it fascinating, I would find it frustrating. So I choose to find it fascinating.
Yeah, frustratingly fascinating. Okay, or yeah.
Let's talk mortgage growth, Patrick, because and I know there's a lot, and I want to talk about bond yields maybe as part of this segment, but mortgage growth right now, if you see compared to where it's been and where it is now, I mean, not a whole lot is moving on the market. And I think the average, and I just spoke at a mortgage brokers conference recently, and I'll tell you a bit more of my experience there, but fascinating. There's no doubt about that.
Well, I want to hear about that. But let's just shine a light on this. The fundamental, and I think we've talked about it on past episodes, is that fewer buyers are going into the market and or even individuals to refinance given mortgage rates. So things are slowing down. OSFI has now had banks increase their reserve funds 3, maybe even 4 times. So in other words, we've got OSFI and / all of the banks very nervous about what's coming up over the next couple of years, given again, not just our Canadian central bank, but all central banks are being nervous. OSFI, of course, oversees it all. And they're saying, you need to pad your bank accounts. In the meantime, lending policies have changed. Buyers are scared out of the market because of what's going on overall economically. They're nervous about their own job security. On top of that, interest rates are high. On top of that, the banks are tougher on lending. And ultimately what's happening is the buyers are sitting on the sidelines because they can't get into the market even if they want. Affordability then is on top of that. So it's a bit of a show right now when you look at what's going on economically. I wish there was better news, but ultimately that's what's going on. Overview.
One thing that is good news is we've already had a rate cut, so that's good. We're expecting another rate cut. If JG has his way, we're going to have a double rate cut in September. But that is the good news is that at least that's moving in the right direction, and interest rates are starting to come down. Patrick, you and I were talking offline a while ago, but investors now are able to get mortgages for real estate investment at low fives, 5.09, 5.15. That's a hell of a lot better, man, than 7.5. Like, yes, 5 isn't ideal, my friends, but it's a lot better than 7 now. And I do think very, very soon we're going to be into the high 4s and into the mid 4s, which is a sweet spot for real estate investment. If you can get mortgages in that 4.3 to 4.8 range, I've always found great cash flow in the 4.3 to 4.8. Now, of course, cash flow at 2%, yeah, loved it when it was at 2% and 1.75. I don't expect we're going back there anytime soon. But the fact is that mortgage rates are coming in the right direction. Variable rates because of the rate cuts, and also the bond yields, Patrick. I saw the bond yields. I didn't check recently, but I checked a couple days ago, and I think it was like 2.9, the 5-year bond yields, which means fixed rates are coming down as well, are trending in that direction.
Yeah, bond yields are far more volatile, if you consider that volatility, than they have been historically. So that speaks to the uncertainty of what's going on in the market. But back to your point about interest rates coming down, JG, if you keep in mind, and you can look at the charts, what happened when they dropped this interest rate back in July or whatever it was, or was there one earlier? I don't remember. I've lost track now. But the point is that a lot of sellers then put their properties and listed properties thinking that buyers are going to start to step up because they see the direction of interest rates coming down, and that just did not happen. You saw listings spike up, but even as this chart here shows us in terms of mortgages, people are not stepping up to buy. You have to have a really well priced, great property to get a buyer engaged. Now, when we look at all of that, there's another part of this conversation that, as much as we see interest rates coming down, that's good for us as investors. We want to see them come down. It'll make our existing portfolios a little more cash flow positive, maybe a little more robust, take that pressure off. And as investors, we might look at it and say, okay, here's some opportunities given the motivated vendors that are out there. But here's what I don't think is going to happen. I don't think you're going to see a big spike in buyers, even if interest rates come down as much as 0.5%. Will it spike? Yes, but not to any degree that will be like monumental. And I'm going to tell you why. It is about consumer confidence. And RAIN members know, and anybody who has followed us, you see that I show always the chart of consumer confidence, because market sentiment, consumer confidence is leading the way in terms of what drives an economy. People are scared. That's it. FUD. Fear, uncertainty, doubt, not just in the real estate market, not just in the equity market, but in the overall economy. And people are fearful of losing jobs. People are just fearful, and they're sitting on their hands. By the way, savings accounts are increasing in the upper percentile. In other words, that demographic of a higher income, mid to high income. That means people are really nervous and they're preparing for what could be happening.
I'm scared.
Interesting, Patrick. And I want to echo the counterintuitive nature of some of these moves, because I'll tell you the story. It was March of 2022. I decided to put a property on the market in January. On December 30th, I got an email from the tenant saying we're going to move. I had been waiting for this email for a while, and I was hoping it was coming because my plan was to duplex that single family home and to turn it into a 2-unit property. That's our specialty at Vistra Property Group. So that's what I was going to do. Now, I got this email and I thought to myself, listen, the market had turned in that particular local neighborhood. I wanted to get out of that property. I said, I think we're at the top of the market. You and I have been talking about on this very show, Patrick, for many, many months before. People got to be careful. I decided, you know what? I think we're at the top of the market or darn close. I'm going to exit this property. That was January 1st, 2024. By the time they moved out, at the end of
January 2023.
2022, you're right. By the time they moved out at the end of January, I did some renovations. Or sorry, they moved out at the end of February. I did renovations from March 1st to March 14th, and it was in early March that they did their first rate hike. And I remember calling my business partner and saying, "Oh, what is this going to do to the demand?" I imagine we might have missed it, is what I said. We might have missed the top. We might be on the other side, but something interesting happened. The demand went up for another quarter. The demand skyrocketed even more, and I think I got $100,000 over asking, Patrick, on that property. And the reason is because I thought it would come down because of the rate hike, but actually the demand went up because people were front loading their purchases. Well, it's the same that's happening now, but the opposite, which is now the rates are starting to come down. People are saying, I'm just going to wait a little more. They've already been in a waiting pattern. Now they know they're going to wait a little more. And this is a counterintuitive part of real estate, which is interesting, but this is how the consumer thinks.
It is. And you take advantage of those opportunities. Now, you also just recently renovated a property. Did you duplex it that you were talking off camera? And you got an appraisal and it came in, what did you say, 80 grand higher than you thought it would?
And yes, this was very, very good. This is a duplex conversion, single family home to duplex. We did a great job, did an amazing apartment in the basement, 2-bedroom plus den in the basement, have a 3-bedroom apartment above. Really ideal, raised bungalow, ideal duplex conversion. I thought that this thing would appraise for probably in the 750 range. I thought 725, 730, maybe 750. I was pushing myself to 750, but I wouldn't have been surprised, Patrick, if I would have got 730 for it. I have other duplexes that appraise in that range, so I thought that's interesting. And that's the other thing. We did not renovate the upper unit all that much. We did a huge job on the bottom, but the upper, we put a tenant in there. We got it rented right away. Anyways, point is, ended up appraising at 830. And this is fresh, man. This is like last week. Last week or 2 weeks ago. So, the appraisals are definitely there. And that's one of the biggest things with our strategy at Visture, where we take single families, we make them duplexes, or we add coach homes, is you need to get good appraisals. And I was very, very happy to see a good appraisal come in. So what this does is now that, and this is a key part of the puzzle, because I've been working with a lot of clients and showing them, now that interest rates are on their way down, and a lot of people finance these types of properties through their lines of credits and so on and so forth, which is governed by the variable interest rate. Now that those interest rates are on the way down and appraisals are on their way up, this is a perfect storm, and you can get good property pricing right now. That's important, Patrick. Your acquisition price on a property is very good right now. And as interest rates come down, people think the price of real estate is going to come down. That doesn't happen not in our real estate, Patrick. Condo market, that's a shit show in itself. You can speak to that all day long. That's a different business. Single family homes, the price will not come down as interest rates go down. Let me say it again. The price of real estate in the single family market is negatively correlated to interest rates, meaning as interest rates come down, the price is going to go up and vice versa.
And we're talking about, by the way, when we talk about single family, we're talking about detached, semi-detached, which are under 5 units. So in other words, it's not like you've got a bungalow. Although prices won't come down on those bungalows, but when we talk about duplex, triplex, fourplex, that kind of stuff, that's what we're referring to when we talk about single family. I think there's a interesting point that we should shine a light on. And what's your thoughts on this is that, as much as you appraised for 80 grand more, that was fine for you because you're actually refinancing. You're pulling cash off the table. You're doing all the things that you're doing. You're hanging on to that property.
I'm putting it into the coach home.
Right. But okay, so whatever you're doing with it, my point is that although it appraised for 80 grand more, you are in fact not selling it. So it doesn't mean that and that's a key point here, is that you're not selling. So it doesn't mean that there's a buyer out there that's willing to pay that extra 80 grand when you did your comparables, or whoever did your appraisal actually came in and said, based on what's going on in the market, it's worth 80 grand more. The bank says, awesome, we're going to lend you the money based on that appraisal. But that doesn't mean you're going to have a lineup of buyers that are coming in willing to pay that price.
Yeah, that's correct, Patrick, 100%. The appraisals are based on obviously comparables. So I couldn't have got 830 if there wasn't comparables out there, for sure. So it's a justified 830. Otherwise, it wouldn't work. But you're right and I think the point you're making is an appraisal for financing purposes is different than putting your property on the market. And by the way, Pat, well, that's it. But also, oftentimes, and we're not there right now, but many times in the market, it's the opposite, which is I'll get an appraisal for a property at 830, but I could actually sell that property for 900 if I sold it. You know what I mean? Like that often happens. That's not necessarily the case right now. It depends on the market you're in, but oftentimes that does happen. So there's money on the table for those willing to sell.
We need to shine a light on a couple things. Really, you look at what's going on in Ontario and just how soft things are in Ontario overall, by the way, not just in real estate. We're starting to see that unemployment rate come up. And specifically, when you look at an average of Ontario at 6.7%, I think is the most recent July numbers. I think that will get adjusted up a little bit. But when you look at specifically into, say, let's say Toronto or GTA, you see that number bump at 8%. And I think we're going to see the leg of construction jobs really come on. We've been talking about that for months. It's starting to come through now, and we're going to hear a lot more about that. But let's, come over to British Columbia, where it's really flat. Costs are really, you look at what's going on in the downtown market. It's not unlike what's going on in Toronto. But then you look into the Fraser Valley, Lower Mainland, prices in condos are softening. Back to what you just shared, and we've shared many times, is that single family detached or semi-detached units are in fact not available, but they're also not coming down in price. Then you get over to Alberta, and Alberta is like, gangbusters still. Deals are being challenging. Edmonton is in fact picking up the slack, starting to catch up and get some momentum in certain sectors of Edmonton. So the point of it, I just want to shine a light on, is that as much as we're talking today, we've been kind of talking a lot about what's going on in Ontario, but it does translate into what's happening in Vancouver, a little bit what's happening in British Columbia, and the anomaly in all of it continues to be what's happening in Alberta. And, right now, for example, Grand Prairie, which is, an oil town and the province of Alberta, we're starting to see rents come up a lot, and we're starting to see in some regions caps. In other words, rents have hit their highs. So we'll see what happens over a period of time. So it's just very regional. We've talked about it many times. I just want to remind people that the opportunity for me right now, as much as Alberta's rocking and rolling, you got to go where, things are soft. You got to step into and lean into a bad market. That goes back to the counterintuitive. Everybody gets excited about a hot market. Right now, Alberta's a hot market, and you really have to be heads up with what's going on.
Yeah, that's a really good point, Patrick. And we've been talking about that for a while. And when things were ripping here in Ontario and Alberta was just heating up, we were saying, guys, you really got to think about Alberta. I moved a portion of my portfolio of Alberta. I did some industrial, I did some commercial. Now I got several over there. And you're absolutely right.
Master, your vision was right.
Now, in a market like Ontario, in a market like BC, where things are softer, you have time. There's not multiple offers, that you can play with the terms. I said this on the last episode, Patrick. I put a deal together recently where I'm trying to put a deal together recently where, there's a vendor take back, there's a long closing, there's like 4 or 5 aggressive strategies in there. It's all on the table right now. That's a great place for investors, but you got to know what you're doing.
Well, how many times? It was like, I think 2 years ago, and I set this in our newsletter, but I think it was 2 years ago that you and I and Barry McGuire, we got Barry on because Barry is definitely the OG of, advanced strategies. And we talked about agreements for sale. We talked about rent-to-owns and having people get the education. That was 2 years ago, I think, that we said that, and maybe 18 months ago. But the point is that we said these are the times right now. What we're living in right now is the opportunities to do those strategies, those advanced strategies for agreements for sale, rent to own as examples. The point is that we saw this coming. And for those who kind of took the time to get the education, and I shine a light on this, JG, because investors right now, many are just sitting on the sidelines. Now, I don't necessarily disagree with that. Go ahead, sit on the sidelines, but what are you doing with your time? Are you being methodical? Are you looking at deals? Are you searching for deals? Are you networking? Or are you just waiting for something to change? Are you waiting to get into, oh, I hardly wait till we get into a boom cycle and I can buy into that excitement and, ride the wave? Like what? This is the counterintuitive part. This is the challenges that people face. And this is the consumer confidence and the psychological shift in sentiment when you put emotion behind your investing decisions.
You have to look, you're not buying real estate for today. You're buying real estate for tomorrow. And you have to figure out what your tomorrow is. Is it 5 years? Is it 10 years? Is it 15 years? Is it 20 years? And does today play a role? How does today play a role in tomorrow? And, Patrick, if you look at it, for example, I was just playing with this thought experiment a little while ago. But if you think about, I was looking in my head and I was thinking, 4 years, if you stretch out the current picture 4 years just for fun, there's a couple major, and I mean major macroeconomic forces that if you are willing to be proactive today, I think you're going to be very thankful in 4 years from now. And that is this: we just brought in millions of people into this country, none of which, by the way, can buy a house right now. None of them, because they're immigrants. They don't have the credit. By the way, they all came in with a shit ton of money, in case people don't know, but they come in with a lot of money. They can't necessarily buy a house right now. They don't have the credit. They got to build that up. They got to get jobs. They got to find their place, all that stuff. Well, that typically takes, as you've said a million times, Patrick, 2, 3, 4 years for that to happen. Okay. That's major macroeconomic factor number one. In 4 years, you're going to have this wave of people, millions of people that are going to all of a sudden be in a place where they can buy a house if they want. That's the first trend. Second trend, you just talked about today. If we look at, for example, these housing starts, the reason we have the highest housing starts in 13 months is because of 4 years ago. The things we did 4 years ago, pre-pandemic, and all those investments in the towers and all that various stuff, that's coming online today. Well, what's happening today?
Nothing.
Bankruptcies,
Yeah.
Towers are not starting, right? So take that thread and fast forward it 4 years. So in 4 years, you're going to have this massive demand with millions of people now onto the market and this massive supply crunch because of the things that are going on today. That's in 4 years, Patrick. That's going to be a great place to be if you buy today, not if you buy then, though.
Yep. Okay, let's shift back to, I want to hear what
I'm having too much fun. I
want to hear about your conference. What happens? You spoke at the conference. You talked to a bunch of mortgage brokers. Was that who you were speaking with? Yeah,
mortgage brokers. But these are listen, Patch, number one, this is so important. It's a good conversation to have. But I'm talking to this group of mortgage brokers, but these are the elite. And when I say the elite, I don't mean like they're the elite in the perspective of they have their mindset right. So they understand that they create their own economy. They understand that, yes, it's a tougher market right now, but if I invest in myself, if I invest in my business, if I grow myself and grow my business, I'll succeed tomorrow. And yes, they're having the same challenges as every other, mortgage broker out there, because
every
business, there's a whole lot less demand for everybody. So, they have to be scrappier. But they're investing in themselves. So I'm amongst the elite from that perspective, Patrick. Elite's not a bad word. It's kind of been demonized recently. But anyways, I'm amongst the best of the best from that perspective, Patrick. They have really great minds. So it was a fantastic conference. I was there speaking about coach homes, and I was showing them like a case study of how a coach home, how taking a single family, turning it into a duplex by adding a secondary suite, and then adding a coach home, so turning a single family into essentially a 3-income property, how much that changes the numbers. And they were blown away. And this just goes to show you how much not only Rain, but Vistra Property Group, myself, how we're at the tippy top of this trend that is to come with these coach homes, because I truly do believe that this is what's going to solve the housing crisis. I think it is a huge step in the right direction. And these mortgage brokers are really looking to put deals together. That's the thing that people don't understand, is if you have the right mortgage broker, they are there to work for you, and they are there to put deals together. And the company I was speaking for is absolutely next level. I've used them for many, many years. Patrick, you know of them. You've worked with them many, many years as well. They're the best of the best. And as a result, they're looking to put deals together. And this is the kind of information that helps them put deals together. So we're educating them on coach homes and how it changes the outlook of the financials, and how you can turn a negative cash flowing single family and how you can create cash flow by adding a coach home. So it was awesome. It was a great time.
100%. I think there's a fundamental here as we start to wind this down is that, at the end of the day, psychologically, these are tough times. Emotionally, these are tough times. When we look at what's going on, whether it be politically, when we look at what's going on global macro, when we consider the reality of what's happening in Middle East or Russia or China, there's a lot of just seemingly big headwinds coming our way. Some of them have actually started to arrive. But this is, in fact, the time to kind of step into the market. Doesn't mean you've got to start writing checks and doing deals, but you need to be in it. You need to immerse yourself. One of the things about what you've got going on, for example, that you are, in fact, a full-time operator, investor, developer. You're in the trenches. So you're seeing it from a different perspective. And that's one of the things that I love having these conversations with you, because you're in it. And when you start to realize that this is where getting into it is where opportunities start to show up. You start to get a feel for the market. And this is my guidance, the wisdom is it is counterintuitive, but you've got to get off the sidelines, which does not mean go out and buy the next deal. When I'm saying get off the sidelines, if you're a little bit nervous and afraid and you're going, this is such a stupid time, or whatever story you're telling yourself, get engaged, get into the network, have conversations, start to get a feel for what's going on. That's where opportunities will get created and or show up that you'll be more confident in doing. Sitting on the sidelines, just waiting for some media headline to change, you are going to be so far behind the curve. And JG, I love the perspective that you bring to it because you're in it. And I'm doing the research on it. I'm talking to investors on a frequent basis. And, it just is now is the time to be engaged, get the education, learn, pay attention to what's going on economically, and you're going to start to pull the trigger on some deals. So I want to just hit that spot.
I appreciate that, Patrick. And I think the reason for that, and I'll tell you what makes it possible for me, and it could make it possible for everybody, which is I just look at my timeline. If I was trying to exit this whole thing, if I was trying to wind it down here in the next 2-3 years, I probably wouldn't be. I can guarantee you I would not be making the moves I'm making now. But that's not my timeline. And that's what I've been telling people for 2 years now. And I've been getting really loud about it the last 6 months because if your timeline is 5, 10, 15, 20 years, my gosh, you are being handed an absolute gift if your timeline is long enough. And if you're getting into real estate and your timeline is less than 8 years, probably should look at something else, frankly.
100%. So I often use the phrase, confidence is rarely owned. It's almost always borrowed. It is and does take some courage to step into this market, but you don't have to do it from a throw stuff up against the wall, see what sticks, be responsible, be pragmatic, but get the hell off the sidelines and pay attention to what's going on in this market. Because I'm telling you right now, JG, whether it's you or a number of other more sophisticated investors that I'm speaking with, deals are getting done and they're having a blast in negotiation because they're just like, okay, they're now all of a sudden vendors, sellers are coming back. Okay, well, no, you need extension? No problem. Okay, got it. How about this? And all of a sudden, the negotiation is a totally different place to be. And as a buyer, as an investor, what do you want? You want the ability to negotiate. So I get that it's a frightening time, but stay engaged, stay with the network, surround yourself with like-minded people, and you will, in fact, grow that portfolio. Buy a door. That's really it. One incremental step at a time.
And that could make all the difference, Patrick.
All the difference.
There you have it, folks. Episode number 46 of Rein It In. Fantastic conversation. Covered a lot of ground today. And Patrick, I'm looking forward to the next episode.
We're going to crush it again. So if you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.